My name is Vashi and I like to talk about finances, well-being and being single. This is part 5 in my 10-part investing series where I break things down to the absolute basics because I believe everyone, you, me, everyone, can and should know how to invest. Thank you for being here with me today. I really appreciate it. And if you haven't already checked out parts 1 to 4, I will link them down below. Please do check them out. In my last video, part 4, I touched on what investing in stocks and funds actually means, and that in general, investing in funds is a good way to diversify your investments. So in this video, I'm going to talk about, at a very high level, about what the different types of funds are. I'm going to touch on 3 main categories of funds in this video, so mutual funds, segregated funds, and exchange traded funds. Funds offer a super easy and convenient way to invest, and this is both for people who are new to investing and also people who are really experienced in managing their investments. Mutual funds lets investors pool money together in a fund that is then managed by an investment firm. It's a process that diversifies your investments and potentially protects them from market fluctuations. With segregated funds, like mutual funds, there's also a pooling of investments, but the difference is that with a segregated fund, your investment comes with an insurance guarantee that protects some or even all of your investment. And these are usually combined with a life insurance policy. And that's pretty much all I want to say about segregated funds in this video. I'm going to touch on mutual funds predominantly in this video because I feel like that's a bit more applicable for the average investor. Mutual funds are one of the most popular ways of investing, and like I said before, this is both with new investors and those who are super experienced. And again, like I said, they can be super convenient because you don't actually have to pick the separate stocks, you don't have to do too much research or any of the decision making yourself. It's all managed by the investment firm. Mutual funds hold many different securities, which is basically a fancy way of saying a financial asset that you can buy and sell. Here are some types of mutual funds. So first we have the index fund. Index funds are the most popular type of mutual fund, and even Warren Buffett swears by these. Index funds have a portfolio that's constructed to mimic and track the market, and by market we mean stocks and shares in different companies in various different sectors. Diversification, you know? Index funds are a passive form of investing, which means you put your money in and no one really moves it around too much. And the idea is that it tracks the market, which is generally on an upward trajectory over time. And like I've covered in so many of my videos up till now, that this is generally about 5 to 7% of growth per year. Because these funds are a passive way of investing, the fees for this are generally lower than funds that are actively managed, as no one actually goes in and changes things about too much. A good example of an index fund, and a very popular one, is the S&P 500, which various investment firms offer, so you'll find that Vanguard do one, Fidelity do one, etc, etc. The next type of mutual fund is a sector fund. A sector fund is a fund that invests solely in companies or businesses in a particular area or sector of the market. As the name suggests, there's generally a bit more volatility in this type of investing because these funds tend to focus only on one part of the economy. Investing in sector funds can be both active and passive. An example of this type of fund would be a fund that invests in different companies in the renewable energy sector. Okay, next up we have growth funds. Growth funds are funds that focus on investing in companies that have shown above average growth. So funds like this will typically include a lot of tech companies such as your Apples, your Googles, your Microsofts. Most growth funds are higher risk than, for example, index funds, but with any investing with higher risk, there is a potential of higher reward. And therefore, investing in growth funds is better suited to investors who have a higher risk tolerance or who want to invest for a longer period of time and don't really feel the need to touch that money. And the final type of mutual fund that I want to touch on is called value funds. Value funds invest in companies that are deemed to be undervalued, and these types of funds are typically held by long-term investors. And finally, the last type of fund that I want to discuss is an exchange traded fund, or an ETF for short. Like with index funds, which are a type of mutual fund, with ETFs you can also invest in funds that track the market. However, the main difference between index funds and ETFs is that, like common stocks, ETFs are traded throughout the day, and so it's much more easier to buy and sell your investment in ETFs than it is index funds, because index funds are priced at the end of the day. You'll often find that the term exchange traded fund and index fund are used interchangeably. However, this is the main difference. ETFs you can trade throughout the day, but with index funds they are priced at the end of the day. And again, like I've said, similar to index funds, with ETFs, you can invest in funds that track the market. And again, most major investment firms will have their own ETF fund. Okay, so that's a super high level overview of the different types of funds. I hope you found that useful. My next video will be about investing in bonds and a bit more information about what bonds actually are. I'll see you there, okay? Bye!